Hey everyone, welcome. Today we're going to jump into something that, yeah, can feel a little complicated, but it's also one of the best ways to build wealth out there. We're talking about the stock market, and we're going to break it all down super simple in this beginner's guide. So, does the stock market just seem, I don't know, intimidating? If you've ever felt like investing is this secret club for Wall Street pros, trust me, you are so not alone. But the truth is, the big ideas behind it, they're actually pretty simple. My whole goal here is to give you that clear, solid foundation so you can feel confident getting started. All right, so here's our roadmap for today. First up, the big one. What even is a stock? Then we'll get into why you'd even want to invest and how prices actually work. We'll also touch on the difference between common and preferred stock, and then we'll wrap up with the most important part, your actual first steps to get going. Okay, let's dive right in. What is a stock? I mean, really, before we get into any of the jargon or the fancy charts, let's just strip it all back, because at its heart, it's a way simpler idea than you might think. So a stock, you might also hear it called a share or equity, they all mean the same thing, is literally just a small piece of ownership in a company. That's it. When you buy a stock, you're not just buying some ticker symbol on a screen. You are becoming a part owner of that business, for real. You know, the easiest way to think about this is like a pizza. Seriously, if a whole company is the pizza, buying one share is like owning a single slice. And what does that mean? It means you have a real stake in how that company does in the future. And, maybe more importantly, you have a claim to a slice of its profits. Okay, so you own a piece of a company, a slice of the pizza. But so what? Why does that actually matter to you? Well, for investors, it really boils down to two main ways you can make money from it. First up, you've got what are called capital gains. This is the one most people think of, right? You buy a stock at a certain price, and if the company does well and grows, the value of that stock goes up. Then you can sell your share for more than you paid for it. Simple. The second way is through dividends. Now, think of these as like a cash bonus. Some companies decide to share a chunk of their profits directly with their owners. And hey, that's you, the shareholder. It's a direct thank you for investing in their business. This naturally leads to a really big question. What actually makes those prices go up and down every single day? It can look totally random from the outside, but it's all driven by one of the most classic ideas in all of economics. Yup, you guessed it. It all comes down to supply and demand. It's that simple. If more people want to buy a stock than sell it, well, there's a lot of demand, and the price gets pushed up. On the flip side, if more people are trying to sell than buy, you've got more supply and the price drops. Every single price you see is just the result of this constant tug of war between buyers and sellers. So what's pulling the rope in that tug of war? Well, it's usually a mix of three main things. First, the company's actual performance. You know, are they making money? Are their sales growing? Second is market sentiment. This is all about emotion. Breaking news, hype about a new product, or even widespread fear. All of that can move prices. And third, you've got the broader economy. Things like interest rates or inflation can kind of lift or lower the entire market, like a tide. Now, here's something important to know. Not all stocks are created equal. When you're just starting out, it's super helpful to understand the two main types that companies offer. We're talking about common stock and preferred stock. All right, let's break down the key differences here. Common stock. This is what most people own when they talk about buying stocks. The big perk? Voting rights. You actually get a say in how the company is run. The trade-off, though, is that your dividends aren't guaranteed. Now, preferred stock is a different animal. You usually give up those voting rights, but in return, you get two pretty cool things. First, a fixed, predictable dividend payment. And second, and this is a big one, you get paid those dividends before any of the common stockholders get a dime. This makes it lower risk, but it also usually means there's less potential for that crazy explosive growth. Okay, we've covered the what, the why, and the how. Now for what might be the most important part of all. What are your first actual real steps to get started? The good news is it's way easier than it used to be. Step 1. Open a brokerage account. Think of this as just your online account for buying and selling investments. Super simple to do these days. Step 2. Choose what you want to invest in. You could pick individual companies you really know and believe in, or you could start with something that's already diversified, like an ETF. Step 3 is absolutely crucial. Diversify. You've heard the saying, don't put all your eggs in one basket. It's so true here. Spread your money out. And finally, step 4, maybe the most important. Think long-term. Real investing is a marathon, not a sprint. It's all about that growth over years, not days or weeks. And this right here is what diversification actually looks like.
Instead of betting your entire future on, say, just tech stocks, a balanced portfolio spreads your investment across a bunch of different areas of the economy, like healthcare, consumer goods, you name it. Why does this matter? Well, if one sector has a really rough year, the others can help cushion the blow. It's such a simple but powerful way to manage your risk. This really gets to the heart of that long-term mindset. This quote from Warren Buffett says it all. Successful investing isn't really about being the smartest person in the room. It's about having the right temperament. It's about having the patience and the stomach to ride out the market's ups and downs, because they will happen. Resisting that urge to sell in a panic when prices drop, that is one of the hardest and honestly one of the most profitable skills you can ever learn as an investor.
So let's just bring this all home. Investing. It isn't about being a genius who can perfectly time the market. It's about something much simpler. It's about owning a small piece of the great companies that are literally building our future. It's about getting to participate in their growth over the long haul. So the only real question left is, are you ready to own your piece?